Okay, so trading with an EMA or an estimated moving average um, is fairly easy, and it's probably the most commonly used indicator. I think the EMA and RSI are probably the two most used indicators, with the 200 EMA kind of being the most widely used. As far as the smaller time frames go, all these ones up here, everybody uses different ones, but 50 and 200 seem to be relatively the most common. So first of all, an EMA is basically it's a moving average over the course of however many days you select. So this one is the 200. It's collecting data over 200 candles or 200 days. So in this case, it is 200 candles because we're on the daily chart, and it's printing that average price on your screen in the form of a line, which is this. So the difference between a simple moving average and an estimated moving average is a simple moving average pretty much uses just the average open close of each candle, puts them all together, and would print a line based on that data alone. An estimated moving average actually takes the more recent price changes and will weight those more. So they play a more significant role in the movement of the EMA than candles back here. So these candles back here are taken into account, but if this has a wild day, this is going to have more of an effect on the EMA than the actual full average will, and that's why traders like the EMA versus the SMA, just because say this stock team has news that comes out today, and they're acquiring another company, and it sends the stock soaring, and instead of trading at 216, now it's trading at $300 for some reason. The EMA is going to move upwards a little bit more quickly. So if that is a justified price, then that EMA is going to catch up to the price, and you can start trading it like a normal stock again, instead of like this massive jump forward and now it's super separated from the EMA. It just kind of prints more recent data on your screen a little bit quicker than an SMA. And what is significant about the EMA or the 200 EMA would be the fact that it is used as support and resistance. So um, you can see here just these two recent data points. It did fall beneath the EMA here. The first day that it fell beneath, it was a hanging man. So it tried to push back up above the 200. It finally broke above the following day. Then it had kind of this half day, and it eventually ended up gapping up above the 200 EMA, stayed above it, and now it's using it as support again. So you can see it was definitely, there's something going on around the 200 EMA that is creating support. Now, as you move back further, you can see it kind of is testing it down here, testing it a couple times there, testing it here. So it is testing it over the course of its trading history. You can see here on the 200 EMA, it did hit, it fell beneath it here, immediately went back up, kind of consolidated along the 200 EMA. Even though this was a head and shoulders, it broke upwards and kind of ignored that pattern. And then here you can see, again, broke beneath the 200 EMA and then used it as support and kind of bounced off of it. So I can give you another example here on Tiger. And so this 200 EMA is fairly new, but you can see here, let me get rid of that. You can see here it had this massive price increase, which we actually all traded. And then as it fell beneath these highs, you can see it started using this 200 EMA as resistance, or as support. So with this huge increase, this 200 EMA moved upwards more quickly than an SMA would have. So if you had the SMA turned on, that might be printing down here, and you wouldn't really understand why it's using this false support line. With the EMA, you can see it's clearly bouncing off the 200 in these two spots. And so that's also kind of where most of the volume is. You can see here on the profile, a lot of volume is right down here at this 200 EMA area. And that's kind of where these last bids are catching the stock. So the 200 EMA is an extremely good tool for swinging and for you can use it to day trade if it's kind of a day that it broke above the 200 EMA. But for swinging, it's great. So with Tesla here, you can see it's actually right underneath. So it's had 2 daily closures underneath the 200 EMA, which is bearish. Now this could push down if it can't break back above it, but in this case, um, I would not swing Tesla until it breaks back above the 200 EMA. Once it breaks back above the 200 EMA, I feel like cool. We're kind of we're out of this red zone. We're back above this resistance, and we can kind of freely move higher and just deal with the normal support and resistance points that we have with the candlesticks, with the volume. But this 200 EMA is super strong. There's a lot of traders that are using this. Like I said, it's one of the most widely used indicators. So you know a lot of people are going to affect the price of the stock that you're watching based on the same indicator that you're using. Not everybody's using volume profile, so not everybody's using volume by price and kind of focused on those points, which if everybody's looking at the same thing and making trades or sells based on the same information, it's going to influence the price of that stock significantly. That's what goes on with the 200 EMA. So with Tesla, I would not be touching this until it breaks back over, kind of consolidates, and you start to see it lift off away from it, moving in on to kind of another bullish, another bullish trend. I think the last time it touched the 200 EMA, it was actually when it was 70. Oh wow, I guess it's not even. It was the 50 EMA that I was talking about. But yeah, Tesla does not really mess with the EMA, the 200 EMA too often. It's just very, very strong. So it being underneath the 200 is kind of concerning. So I would not be surprised to see this drop a lot lower, kind of falling to this area here, this 450 area, which is something that I have been waiting for. So once that happens, then the 200 EMA will follow. And then we're just going to be trading it the same way. We'll be short as long as it's underneath it. And then once it hops back above it, we'll go long. And that's how I personally use the 200 EMA. Excellent thing to watch for bounces. You can swing trade stocks based purely on a bounce. And so that was something that I really like about Team, is if you had just played this bounce here, then you would go from 207 up to 244. So that would be a 25% move, almost a 25% move, about a 20% move on common stock. And if you were on options, that would be an insane profit. But you can do that just on a bounce from one indicator. So you can turn every other indicator off, only look at the 200, and I think that you would trade fairly fine. So this is one that if you are not using, you absolutely should. For record, I have the 200 EMA, I have the 50 EMA, I have the 34 EMA, and the 20 EMA. And then I have, these are clouds. These are the 9 and the 21 EMAs. That's what this purple and the green kind of clouds are. So those are the EMAs that I use, and I find that they're respected. This on the daily and the 4 hour, the 200 EMA, the 50 on the daily for 2 and 1 hour, the 34 EMA for those intraday kind of 15 minutes to an hour, more 15 minutes, 30 minutes. And then that 20 EMA is solid for, 5 minute, 10 minute, 15 minute. So they're all used for different things. They all are calculated the same way. It just changes based on the amount of days that you're kind of inputting. But yeah, extremely useful tool and should definitely be used on your charts.